Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Palantir Technologies Inc., ticker symbol PLTR. We've just reviewed their latest Q3 results, which their CEO Alex Karp called arguably the best results that any software company has ever delivered. But here's the paradox. Despite that huge claim, that monumental execution, the stock immediately dropped 8% after earnings. So the central mission for this deep dive is to answer this. How do you reconcile historic operational excellence, real, tangible success, with a market valuation that is, well, utterly merciless?
That tension right there, the paradox of perfect performance somehow not being enough, that is the core of the Palantir story right now. Our sources really define the conflict this way. Palantir is betting its artificial intelligence platform, or AIP, and its unprecedented 114% Rule of 40 score will sustain the required hypergrowth. And that has to justify an extreme price-to-sales ratio of 117 and a price-to-earnings of 454 against the structural drags of a stagnant international segment and the, frankly, inevitability of competitive margin pressure.
A PS of 117 and a PE of 454. Wow. I mean, those are numbers that demand near perfection. Just for context, for those of you who might be new to this kind of extreme growth stock valuation, price-to-sales, or PS, tells you how many dollars the market is willing to pay for every single dollar of revenue the company makes. So a PS of 117 basically means the market thinks Palantir's revenue will grow exponentially for years just to justify today's price.
Exactly. It's a valuation that doesn't just predict success, it demands magic and constant acceleration. To really unpack that, we have to start by defining the financial engine making this whole conversation possible. Let's look at those decisive Q3 figures they just reported, because they were certainly remarkable.
They truly were. Palantir hit $1.181 billion in total revenue. That's up a huge 63% year over year. And what stands out to me is that this growth has been accelerating for 9 quarters straight. That's a long time to keep building momentum, especially at this kind of scale.
It speaks to incredible operational rigor. But when we look at their financials, it's not just the top-line growth that's impressive, it's the quality of that growth, defined by their efficiency. They had a 51% adjusted operating margin. And maybe even more important for showing their maturity, their GAAP net income, that's pure profit, was $476 million. That translates to a massive 40% margin.
Hold on a second. A 40% GAAP net income margin? For a company that's scaling at 63% year over year, how does that even compare to the established giants?
It compares favorably to almost everyone. For this quarter, Palantir actually delivered a higher GAAP net income margin that's 40.4% than both Microsoft and Google. When a company that's known for aggressive R&D and just rapid expansion delivers that kind of foundational profitability, it completely shifts the investment narrative. It proves they have immense pricing power and operational leverage just built right into their model.
And the metric that really grabbed all the headlines was that hyper-efficiency metric, the Rule of 40 score. This is where you combine the growth rate and the adjusted operating margin. The sources show Palantir's Rule of 40 score just soaring to 114%.
114%. Just to put that into industry context for you, the average for a high-performing software company is usually somewhere between 40% and 60%. A score of 80% is considered outstanding. Palantir hit 114%. And it increased 20 points sequentially in a single quarter.
20 points in just 3 months. That is unheard of.
It is. And this is the metric CEO Alex Karp was referencing when he said it proves that value creation, not hype, is what defines the real AI market. The financial strength is just indisputable. We see it reflected in their cash flow, too. Adjusted free cash flow was $540 million, a 46% margin, and their trailing 12-month adjusted free cash flow has now passed $2 billion. The company is generating cash at an accelerated pace while, at the same time, driving this extreme growth.
So these profits are staggering, but they don't just appear out of thin air. They're a direct result of the technology, which is unique. Let's talk about the engine making this all possible. The core advantage seems to hinge on 2 platforms. What's the foundational moat that enables this hyper-efficiency?
The foundation is what they call Ontology. Think of Ontology as the critical structural core. It's the translator layer that sits between messy, unstructured enterprise data, emails, PDFs, factory sensor readings, and the actual AI models. It converts all that chaos into structured contextual models. This is absolutely essential for modern large language model operations.
Okay, so why is Ontology so critical right now, specifically for enterprise AI?
Because it provides the reasoning that goes into decision-making. A large language model is great at generating text, but it's terrible at operating safely within a real complex enterprise, like managing a supply chain or launching a military strike. Ontology provides the guardrails and the context that allows the AI to operate reliably, which gives Palantir a massive head start on safety and utility.
So if ontology is the foundation, then the growth engine right now is the artificial intelligence platform, or AIP. That's where customers actually interact with the AI. And this is clearly driving huge enterprise commitment. It's reflected in a record $2.8 billion in total contract value TCV bookings for the quarter. TCV, for our listeners, means the total lifetime value of contracts they signed. And that figure was up 151% year over year.
Right. And AIP is where we see that immense operational leverage translate into real business transformation. One of the most shocking anecdotes from the sources involves their tool called AI FDE. That's the Foundry Development Environment, which automates integration and application development.
Tell us about that migration example, because I think it really captures the disruptive nature of this tech.
It's stark. One customer used AI FDE to complete a full data warehouse migration, so moving all their historical and current operational data in just 5 days. That exact task, traditionally managed by large systems integrators like the big consulting firms, would normally take up to 2 years to complete manually.
2 years reduced to 5 days. That's not efficiency. That's a wholesale revolution in how enterprise IT is managed. That has to be putting tremendous pressure on traditional consulting models.
It certainly is. And this operational leverage is clearly visible in the company's headcount. Remember, revenue grew 63% year over year, but their overall headcount, it grew only 10%. They are deploying AI to do the work that previously required hundreds of engineers, which is exactly why they're hitting those record margins and why that Rule of 40 score is 114%.
Let's pivot to the segment that's really driving this acceleration, U.S. commercial. This has gone from being a promising segment to the outright hyper-growth engine that underpins the entire investment case.
It has. The U.S. commercial segment grew an explosive 121% year over year, hitting $397 million. That was the best result for that segment in 11 quarters, which tells you that the new AIP platform is truly finding product-market fit in a way their older products hadn't.
And they're not just signing new customers, they are locking existing ones in, which suggests their AI solutions become mission-critical very, very quickly. The net dollar retention, or NDR, is up to 134%. That means even if they had signed 0 new customers, revenue from their existing base would have grown by 34% year over year just through upselling.
The momentum is just undeniable. They closed $1.3 billion in U.S. commercial TCV. That was a 342% increase year over year, a shocking number. And crucially, they closed 53 deals over $10 million. When you see deals that large, it signifies a behavioral shift at the executive level.
What exactly is that behavioral shift? Is this still IT departments buying software, or is this coming from higher up the chain?
Oh, it's a C-suite mandate. We are seeing customers convert to large enterprise-wide agreements in extremely short timeframes. They're moving directly from, say, a limited pilot program, just testing AIP out, to deciding on an enterprise-wide AI transformation within months, not years. CEOs are recognizing that implementing this kind of AI infrastructure is now the defining factor that separates the competitive haves from the struggling have-nots. That urgency is what's driving the 121% growth.
Okay, now let's touch on the other foundational pillars, starting with the government side. The government segment performed strongly, which put to rest some claims that its growth was unsustainable. U.S. government revenue grew 52% year over year to $486 million.
And that growth is built on strategic entrenchment that is almost impossible to disrupt. A major milestone recently was the U.S. Army issuing a directive to consolidate all their data platforms under Vantage, which is built on Palantir's Foundry and AIP. This centralizes data-driven decision-making for the entire military branch. It essentially makes Palantir the default operating system for their data.
We also have to mention the strategic alignment with Nvidia. This isn't just a simple customer relationship. It's a deep partnership. It involves technical and operational integration, even joint sales activities.
The Nvidia partnership is a massive validation. It brings together Palantir's software logic with the best AI hardware out there. The relationship is so tight that Nvidia's CEO, Jensen Huang, explicitly called the Palantir Ontology probably the single most important enterprise stack in the world. When the leader of the entire AI chip revolution makes a statement like that, it sends a powerful signal to every CEO on the planet.
Okay, that brings us to the primary structural drag on the whole Palantir story. Right next to the U.S. explosion, which is growing at 121%, we have the international commercial segment. The revenue there grew only 10% year over year. It hit just $152 million. That is an enormous disparity between the U.S. and the rest of the world.
It is the single biggest structural risk outside of the valuation itself. I mean, that growth rate is glacial compared to their U.S. performance.
And Palantir's CEO, Alex Karp, he attributes this to a cultural critique of what he calls stagnant Europe. Now, hold on. Isn't blaming the entire continent of Europe for your own company's poor sales a huge evasion of responsibility? What did the analysts say about Palantir's actual sales strategy in these regions that are lagging?
Well, it is certainly a pointed cultural critique, and it suggests a profound difference in readiness for AI adoption outside of the U.S. Karp essentially argues that the centralized, top-down AI mandate that drives these quick conversions in the U.S. military and in C-suites it's lacking in Europe and other international markets. He says the cultural and regulatory hurdles there slow down massive enterprise IT transformations.
So the argument is that this slow growth is an external problem, a cultural cost, rather than an internal one, like a poor international sales strategy.
That's management's position. And unfortunately for investors, that cultural cost is directly reflected in that weak 10% international growth rate. The market needs Palantir to be a global enterprise powerhouse, but right now it's primarily an American hypergrowth story. If that international segment doesn't accelerate significantly, it puts exponential pressure on the U.S. segment to carry the valuation load.
All right, let's bring it all together. We have undeniable, phenomenal execution, a 114% Rule of 40 set against a valuation that is truly, truly demanding. What's the synthesis of the investment case here?
The bull case argues that the sustained hypergrowth, with Q4 revenue guided to a 61% year-over-year increase, combined with that strategic entrenchment in the U.S. government and the validation from the Nvidia partnership, it all makes Palantir the dominant player in the critical high-margin niche of enterprise AI operating systems. They've proven they can scale while generating massive profitability.
But that price-to-sales ratio of 117, it demands performance that borders on mathematically impossible to sustain for a decade. What happens if they don't achieve that level of sustained acceleration?
That's the risk. We looked at the valuation model takeaway, and even if Palantir manages to achieve an ambitious 40% revenue compound annual growth rate, a staggering rate for the next 5 years, that still only results in a stock CAGR of about 6.6% by 2030. And that's assuming a high exit multiple. The current stock price requires not just perfect execution, but an acceleration beyond their currently unprecedented results, which seems very difficult at this scale.
So the final verdict balances the phenomenal execution and AI moat against these structural risks. Risk one has to be competitive margin pressure. Well-funded giants like Microsoft and Google are paying attention to AIP's success. They can deploy billions of dollars and thousands of engineers to develop competing solutions and take market share.
That is the long-term threat, yes. And risk two is growth deceleration. The U.S. commercial segment's stunning 121% growth is expected by analysts to eventually peak. If that engine cools, or if the international segment remains a perpetual drag, it immediately puts extreme pressure on that stretched 117 PS valuation.
The company is delivering revolutionary technology and generating historic profits. But the stock is fundamentally a high-risk bet on arithmetic. It requires an expansion trajectory that must exceed today's already unbelievable reality. The question for you, the investor, is whether you believe management can solve those cultural hurdles in Europe faster than giants like Microsoft can replicate their technology right here in the U.S.
Risk defined, portfolio protected.